Okay, so two more questions about one is about always in, and that's pretty. I'll kind of start with that. How do you determine always in long, always in short? That is a very that's a broad question, and that's there are so many factors to determine that. You know, is it a gap? Is there a gap up? Is there a gap down? What are the first you know gap down three? Always in short from the close. How many bars up? Context. Are we near obvious support? Are we down here, over here? There's so many factors. So let's start with what is the concept of always in? Always in is if you had to take a swing trade or buy at the market at this exact second, would you buy or would you sell? That is always in. So with that said, let's just see. Today's okay. So Monday was the 26th. That does not. Yeah. Okay. So let's go to the 26th real quick, and let's just think through it. Okay. So if I had to do anything, we have a gap down on the open. If I had to do anything on the open, I would sell. Bar one, it's a gap down. So if I had to do anything, I either am going to buy the close of bar one, stop below bar one, or I'm going to, and I probably won't do that because I know bar one's probably going to trigger. It doesn't make much sense. Or I'm going to sell the close of bar one, sell below bar one, with the stop above bar one. Well, if I had to pick one or the other, I'm going to sell. Okay, over here. If I had to pick anything, would I sell above this bar right here, second entry buy, or would I buy? I'm going to buy because I think it's a gap down. We're probably going to test the moving average. The bear's probably setting up an opening reversal. So if I had to do anything in that second, I'm going to buy it. Therefore, if I'm short, I need to get out. Always remember, every tick, it does not matter where you get in a trade. It doesn't matter where you get in a trade. So think about it this way. If you're ever trying to figure out if you should stay in your trade or not, ask yourself this. If I was flat, if you're short, ask yourself, if I was flat, would I sell right now? So right here, ask yourself, if you're still short and you're trying to figure out what to do, ask yourself, okay, if I'm flat, would I sell the high of this bar and put my stop up here? If the answer is no, then you need to get out. But a lot of times, this happens to me fairly regularly, fairly often. When I'm trading always in, I try and reverse here and there, but the reality is it's a lot of thinking. It's a lot of, you know, clicking buttons. It's all, sometimes I'm just too slow. So sometimes if I can't make up my mind, I just get out and I'll just wait. So if I can't decide if I should buy or not, I'll get out and I'll just wait. And I'll say, okay, always in long, but pretty strong bull breakout at the high of the day. I'm gonna wait. Okay, bulls get out, still looking to buy. So where do I buy? And if I'm flat, at this point, price is failing at the moving average. So if I had to do anything, I'd sell and get out here, buy again above this bar. Probably have to sell again here, sell this close. Probably get out. I'm expecting a broad bear channel, so 50% pullback, test the moving average. Not really, the bulls are not doing what they need to do. I'd get out of longs here. If I was long, go short. I talk about always in just about every one of my videos because that's how I trade. And there's a lot of factors. Let's start with today. Always in today. And I'll try my best to start explaining why it's always in. So what do we have, on the open of the day? Always in long, always in short. We'll gap up, you know, top of a trading range, maybe find when the day open. Okay, we're at this gap over here, so we're at resistance. So at this point, bar one always in long, but I would not buy, I would not sell below. If I do anything, I'd sell below bar two, but I doubt I would do that. And again, the only thing if I did sell below bar two, stop up here. I'm not going to get out above this bar. Clearly always in short. We have a breakout follow through. Clearly always in short. I'm going to sell this close, stop up here. Do I get out here? No. We got a tail. We're holding below the moving average. I just stay long. Bit deep pullback. Bulls made money, so weakens the case for the bears, but still always in short. Bear breakout, bad follow through. So notice we're getting bear breakouts, bad follow through, bear breakout, bad follow through. So, what I got above this bar, probably not, probably second leg down. Another bear breakout, weak follow through, consecutive bear bars. Here I'm definitely getting out, no question. Three pushes, 1, 2, 3, 4, depends on how you look at it. Maybe it's a wedge, 1, 2, and 3, bear breakout, 2 legs down. We have a measuring gap right there, so possible. We got that, and then we went several ticks below this measuring gap at this point, so you have to be thinking about a measuring gap from here. And someone asked the question actually about they called I don't know what the term, I can't remember the term they used. I call them negative gaps. That's what Al calls it. I got that from Al, obviously. An absent gap. I can't remember the term he used, but he was implying, how do you tell when a gap barely closes that it's going to act as a negative gap and still act as a gap even though it closed? And this is kind of that situation, when price just barely goes one tick above and turns down, it's very thin, they could still act as a gap. So you have to be thinking that, especially when you get price goes up and then closes back down at the bottom. So you have to be aware of that. And a lot of bulls, they think worst case it might fall down to here, but probably won't, and we're probably going to get back up to here and close the gap. I'd get out. You have the best looking bear bar of the move. No one's really left to sell down here, so you have to be thinking 10 bars, 2 legs. So that's what I would do. So the only thing I do is buy. Arguably, and that's kind of what makes it always in long. If I'm willing to get out, it's always in long. But if the bulls cannot do anything strong, bears will get short again. And so right here at the moving average for the first time in a few bars, but we're getting a lot of consecutive bull bars, so it's probably still always in long, but trading range may get a deep pullback down to here. Some bears, they'll get out below, some bulls, but I think we're going to test this high, close this gap, and possibly keep going up. So strong bear breakout, but no real clear reason to go short except for the fact we're at the moving average and at the target. So, and again, bad follow through, bulls bought it. And then here, well, new high and everybody sold it. A lot of times what can change always in is when you get things like this. One of the signs of a trading range, you trade always in based upon the market cycle. If you get a second entry short at the high of the trading range, you need to get out of longs and consider going short. If you get a second entry buy here, great example, at the bottom of a trading range, possibly a broad bear channel, you need to get out of shorts and consider going long. So it's really about the market cycle. For instance, why do we want to sell here? Maybe get out of shorts here. Well, it's a broad bear channel. The bulls are failing to break above the moving average. It's also it's a 50% pullback. So broad channels, trading ranges and broad channels Traders are looking to buy, they're looking to sell 50% pullback. So that's what kind of creates the broad aspect of it. So, that's another reason. But going back to what I was saying, I have to kind of relook at it and remember. Oh yeah, a lot of times when you get, here's a good example. Gap up, always in long bar 1. It's a bull breakout. First reversal down should fail. So we'll probably get a second leg up. We have a second leg up. A lot of times when you get a gap, you get pullbacks that, price goes sideways to the moving average. So always in becomes less important. And, there's no real rush to stay long aggressively. So bulls may buy again because it's double bottom. But when you get a breakout above the high of the day and a new high of the day, then immediately bad follow through, it's a warning that you're in a trading range. So a lot of bulls will get out or get out below this bar and look to buy against the moving average. Consecutive bars down, but it's the first time it's touched the moving average, so you're at support. Always in is everything is determined by support and resistance, which is actually the next question someone was asking me. And that's, just on a side note, someone's asking me about, well, first off, they're asking about support and resistance, but first off, let me go through always in today. Always in short on the close of this bar, stop up here. Bulls probably get out above this bar. Bulls probably, if they don't buy here, stop below this bar, they buy here. So, arguably you call it a double bottom, higher low, major trend reversal. So bulls buy, stop down here, Bulls get out, bears go short. Aggressive bears go short. Bulls get long again, it's a higher low major trend reversal, 50% pullback, 2 legs down, leg 1 pullback, leg 2, leg 1 pullback, leg 2. So it's a reasonable buy, stop down here or down here. And then second entry short at the high of probably a trading range. It's okay for bulls to get out. Maybe bears sell, but you got to think fast because you may get something like this again. And bears get out, bulls get back in, or they wait for this close, maybe this close, or especially here. Do bears get out here? Probably not, but if they do, they've got to get long, get above this bar. And what else? So, they probably don't get out here though. Then we get a strong bull breakout, another bull bar. So a lot of times when you get a second leg trap, and that's what Al was talking about, you usually get a bad follow through on the very next bar, kind of like this. That closes on its low, but this didn't. So probably more up. We'll probably get some sort of measured move at a minimum, which we did. So, somewhere up here, do you get out here? Maybe it's a micro channel, so you don't have to get out there. I'd probably get out below here and just wait. If you've been long since here, you've made a whole lot of money. So I'd get out, and then, a weak pullback to the moving average, so you can buy above, betting on by the close. And that's kind of what Al said, and I pretty well agree with it. So just briefly, bears get out below here because we're just failing too much. We're trying to break above moving averages and failing. We're breaking above the 60-minute, 15-minute moving average and failing. We tried again, we're failing. So a lot of times when the market's unclear, traders are much more willing to get out with always in. And the next person's question is about support and resistance. And support and resistance is extremely, of course it's important for always in, but it's important for everything. It is the basis of trading, is support and resistance. So, this person said, this person's interested in identifying support and resistance zones better. They say, I've noticed some moving averages can act as support and resistance. Likewise, some of the recent historic movements can be support and resistance, such as the high of last week, the high of last month. the low point of yesterday, etc. Well, yeah, the markets are, you've heard the term fractally related, and they are because it's simple. Everything has to match up. You know, and a lot of times, just kind of give an example. Very often, here's a monthly chart. You get big moves on the last month of the last day of the month, and the reason for that, it's just like if you're watching a 5-minute chart, and the bar dramatically changes within the last 1 minute or 30 seconds. Everybody. Let me back up because a lot of we're not all most people aren't trading in actual monthly charts. Let me make it more relevant. Okay, so let's look at the first. Here's a 60-minute chart, and let's look at 930. 930s. So over here, if you think about it, this is all one bar. Well, right around here, you can see that bulls bought and they put a tail on the bar. So little things happen in the last few minutes of the bar closing, or the last day in the bar closing, if it's a weekly chart or a monthly chart. That's why you hear Al all the time say on a Friday, weekly support and resistance are important. That's kind of like how here's the open of September. We close, I believe the last day of the month is Friday. So we are going to be probably staying sideways until Friday, and then if we're lucky, or as Al says, if we're lucky, we'll stay above the open, and on the monthly chart we will have 1, 2, 3, 4, 5, 6, 7, 8 consecutive bull closes, which almost never happens. So the probability would be really high of a sell-off. So the issue, I can't simply identify every support and resistance. There's just so much, stuff down here. For instance, we went sideways for over here, so we broke below it. We're in a bear channel. We broke below bear channel. Most breakouts below bear channels fail, and then we test the top of the channel. We broke strongly above the channel, but the most breakouts of anything, the first breakout usually fails, so we pulled back, had a deep pullback. Now we're trying to go sideways because we went sideways here. There's so much stuff. So, let me look over this person's question. They're saying, yes, the moving average. Moving average is a fair price. So when you look at a moving average and price has been away from the moving average, such as over here, here's a 60-minute moving average. We've been far away from it. We go even further. At some point, traders don't want to sell too far below the moving average because it's a fair value price. Why sell far away from the moving average when you think that it's going to get there? Or in other words, let me restate that. When people have been selling really cheap, it's like if you're trying to sell your car and you have a 2005 or 2015 Lexus, a new Lexus, let's just say, and if the car's worth $50,000 and I offer you $25,000 and it's only got 15,000 miles on it, you're probably gonna laugh at me and say no. Well, that's how markets work. If the price is all the way down here, it's forcing bears to sell really, really cheap. So what are they going to do when it gives them a chance to sell an average price, a fair price? They're going to take it. Same thing with the bulls. At some point, it becomes really, really expensive to buy, and a moving average is a fair value price. So the first chance they get to buy a fair price when they've been paying a lot, they're going to buy. And that's the whole basis of the moving average. It's just simple. It's support and resistance. It's simple supply and demand. That's just how markets work. So I really wish I could be. I wish I could be more helpful with always in and support and resistance, but you know, I'll say this: but when I start the day, I do the same thing Al does, and of course, I learned it from him from watching his webinars for so long. I plot number one. I plot yesterday's high, yesterday's low. So when this day opened, I'm plotting yesterday's high. We gapped above it, and I'm plotting yesterday's low. So my thought is, we're trying to break above yesterday's high. Most breakouts fail. Let's take a look at the daily chart. Okay. So we may sell off. It's kind of like strong breakout above. We may close the gap. We've had a pretty extreme rally. So that's the first thing I would do. I pay attention to the close. Think about daily charts. If you're trading a daily chart, you don't really care about the intraday stuff. You care about the close. So if the close is here, all you care about really is if you're long, will we close up here? So I wish I could be more helpful. Sorry about that. I wish I could be more helpful, but there's a lot of variables. That's really. I just right now I just don't have the time to really go into all support and resistance. Measured moves, measured moves, gaps, leg one, leg two. Sorry, my voice is getting a little hoarse. So, and lastly, this person's question is about how do you make money on the close of the market? A lot of times the market gets really volatile, or starts to move a lot, so it's dangerous. Yes, it absolutely is. And these are some examples. You buy the close, and we start going up. Very end of the day, we just plummet down. This bar happened. I don't even want to know. It happened really, really fast. You can see first minute of the bar, price drops 3 points. So it's very easy to give a lot of money back at the end of the day. You are absolutely correct. Same thing here. Buy the close, but we're trying to break above today's high, and if the bulls fail, we may reverse down sharply, and everyone agrees, then we make money. Then the traders that were fading the breakout make money. One second. Same thing here. Buy the close, but we had a target here. The bulls who bought this low are going to wait and buy more above the bull bar, and eventually, if they held, they made money at the very end of the day, and then we immediately sold off. So, and part of that is due to a lot of traders, they don't want to use wide stops. They're going to be much quicker to get out, much quicker to take profits. So that's one reason. Here's two more examples. Buy the close rally, but first time above the moving average, strong gap down, and we sold off. This was actually this was definitely the Brexit day. So here's another example. Spike channel, 3 pushes up, sideways for pretty much the rest of the day. We tried to break above, and we closed very disappointing, and we sold off. This kind of happened, sort of today. We kind of over here, but sort of. Simple fact that for the bulls to get a really strong rally, I was talking about, we needed a strong close above. Since we did not get it, it increased the chances of a test down, and then we got a strong breakout finally and a strong rally. So a lot of times when you get days like this, this is why a lot of always in traders or swing traders, or most people, do not like to hold when it looks like a trading range and you're high in the trading range, because you can get really quick reversals. So I really hope this helps, and I hope this brings value in some way. Please comment below if you have a specific, question or example. It's always general questions are always hard to answer, and there's nothing wrong with asking a broader question about support or basic support, but it's harder to deliver an exact answer, and that's just the reality of it. It doesn't make this question a bad question. It's a great question. You should support resistance is the most important thing. If you're low in a trading range, you do not want to buy. You do not want to sell. You have to be very careful about selling too low in a trading range and buying too high. It's kind of like, well, here's a good example. Look over here. So okay, so let's talk about always in for a second. I don't even know what's to the left. All I know is we rallied, we sold off, another sell off, another sell off. So climactic 3 pushes down. We test the top of the channel, arguably the start of a trading range. Always in long over here, but when we go up and strongly reject that price and turn down, closing on its low, the only thing I'm going to do is I'm going to sell this low. And if I sell, I'm probably not getting out above this bar. The reason for that is this happens a lot. You get a decent sell signal and then bad follow through in the next bar. That's a warning that we may get some sort of trading range price action. And then you get down here, maybe you get out, but always in, got to get in again. And, so anyways, it didn't really clearly become always in long till always in short till over here. This is kind of one of those, well, it's an example of, Al calls it the Walmart trade. I gotta find that funny just because, well, his whole point behind it is you sell below here, stop up here, you go to Walmart, go buy some groceries, and come back in an hour. Or come back in, 40 minutes, whatever. And you're over here. Some days you do that, and you make quite a bit. So if you're trading always in, you either get, you sell, maybe you get out above, but if you do, you got to get short again below this bar. Maybe you again get out above here, but if you do, you got to probably get short again. So you got to be careful when you're in a trading range. So strong breakout. A lot of traders will probably get out above here because we went sideways, and then we got 2 pushes up. We still have a gap. It's a 50% pullback. So a lot of traders will say, okay, this looks like more like a trading range, maybe a trending trading range day, which is a broad channel. So if we get a new low in the day, I need to sell a 50% pullback and not be selling at the new low. So, somewhere over here, tight channel, bear breakout. So maybe a lot of bears sell here, stop up here, or they just sell over here. But when you're down here, a lot of bulls will get out above this bar because probably a trending trading range day, therefore probably a deep pullback. You're not going to sell a 50% pullback after consecutive bars. So, probably better to let this go. And, if you get out below here, you buy again, or you never really got a second signal. So it's always dangerous to short when you have this many bars up because of the simple fact that you may get a sell-off in a deep reversal. Because usually you have to have a micro double bottom or a double top like this, even though it's not micro. But as far as buy the close, the classic way is, and you're probably asking this because of today, you buy, put your stop below. You get this close, you move your stop maybe 4 ticks below, just in case price goes below a bar and turns up. You get this bar, put it 4 ticks below or 1 tick below. Get this bar, put it 4 ticks below or 1 tick below. And you keep doing that. And when you get a bear bar, you get out below the bar. Most days, you won't really make much. Some days, you will just make a fortune. Kind of like over here. You buy somewhere, maybe you buy over here, maybe you buy this close, and you just keep trailing a stop. You buy that close, stop below here. Maybe you put your stop down here. Then you get this close, put your stop 3, 4, 5, 6 ticks below. Here, put your stop 3, 4, 5, 6 ticks below. Here, get out below that bar, and you make a lot. But I certainly would, I'm much more cautious at the end of the day because, a lot of times you get, it's happened recently, if I can find the day. It's going to take me a minute, but I kind of want to find it. I don't think it was this far ago, but let me see real quick. Yeah, I can't find what I'm looking for, but that's really, that's all I would trade the close. Alright, I'm getting kind of tired of talking with making 2 videos back to back, and I'm already a little tired from the day, so, that's about all the energy I have for now with videos, but comment below if you have any questions, and I'll be glad to answer them. Thanks.